Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back. Another episode of the Apartment Gurus podcast is coming at you. And guys, this is going to be an awesome one. Yeah, we kind of been in a series here of talking to really high level apartment entrepreneurs, multifamily entrepreneurs that are in the space and really killing it. And most of our guests have been a little on the younger side here recently that we've been talking to, which is super exciting to hear from people that are, not even 30 years old yet and are in the hundreds and hundreds of millions of dollars under assets under management and have huge goals for the future, are really just kind of in a magical space in the zone, right? And that's where we all want to be ultimately. And so I'm really excited to have been bringing you guys these guests that really kind of the whole idea of success leaves clues. Well, here's a 45-minute episode full of clues for you coming up, and hopefully you get a ton out of this. This guest is phenomenal, and so without further ado, I want to welcome Chris Salerno to the space. And Chris, I'm really excited to have you on here. Thanks for joining us.
Yeah, Tate, thanks so much for having me. Very excited to add value to your listeners and viewers on this episode.
Yeah. I'm really glad you're here. So here we go. So Chris, we were just talking offline here, and you were telling me a story that I can't wait for you to tell the audience, but let me just introduce you real quick. So you are the CEO of QC Capital, LLC. Are you based in Charlotte?
Yes, headquarters in Charlotte, North Carolina.
Yep. National multifamily investment company. They do apartment complexes of at least 100 units or more in major Southeast markets, the Sun Belt, and focus on markets that demonstrate consistent rent growth, population growth, and job growth, which so many of those markets in that part of the world are doing that. Right. So, you're an experienced CEO, demonstrated a history of working in the real estate industry, and you're skilled in sales, management, teamwork, leadership, project management. And that's really, those are all the skills that it takes to be CEO of a firm like yours. I'm in the same position with Greenlight Equity Group, team leader and CEO and all that. And you really got to have a broad skill set, especially at high level communication and relationships building and team building and that sort of thing. So yeah, you've transactioned more than 40 million in real estate volume. And was that as a broker, or is that you?
Yeah, no. So that was a broker. I no longer have my real estate license. I let all that go back in 2019 when I created QC. I'm a firm believer of focusing on your one thing. So I let all that go back then. So that's when I was brokeraging residential real estate here in Charlotte.
Wow. So you did 40 million in residential?
Yeah, 40 million within 3 years in residential. Just by
that's
myself.
impressive. That's impressive. And you have 1,000 units currently under ownership, or 1,000 plus units currently under ownership, it sounds like.
Yes, at the moment it is switching because we're selling assets and we're bringing new assets in. So
yep. And that's what happens when you're kind of where you are and the cycles and whatnot, when you're exiting projects and then bringing on new projects. So, well, dude, it's awesome to have you on the show, and I'm really looking forward to this. If you wouldn't mind just sharing a little bit about, a little more about your story, a little color into your background, and really like how you got to where you are today, and what you think got you to where you are today.
Yeah, I definitely appreciate that. And it's a great question. I would say, the biggest thing about myself personally is I'm very intrigued with businesses. And at a very young age, I was intrigued with billionaires and how they created such a net worth and how they created the businesses they created. And when I see, if I get a notification saying some business is going bankrupt or, some business achieved this in their annual or quarterly reports, I dive deeper. I want to dive deeper into what was their decision? How are they operating? What are they operating? If they are filing bankruptcy, why, what happened in their company on that journey that something happened to pivot to say they needed to file bankruptcy. I want to know what happened. So I dive deep into it. I do research, and I always was intrigued with that. And that would led me into creating my own company. From that, I merged it with the number one company in the Carolinas, and I was at one point I was their at one point I was their worst agent. And my team was, and within 3 months, I became their top agent amongst 45 different agents within that company. And with that current owner, I was always intrigued. Every time I'd go into his office, I saw his P&L on his table just sitting there. I said, "Hey, can I look at it?" And I kept bugging him and bugging him and bugging him. Finally, he's like, "Here, just take it and look at it." And so I started reading through it, and I said, "Why are we spending this? Why don't we cut expenses here? Why don't we allocate more capital to here for marketing?" And he was like, "Well, you actually have a point." So then we sat down and we started going through it. And then he was like, "Okay, start traveling." So I started traveling with him to other large groups, to other conferences, things like that. And he says, "I want to make you the COO, operations, and you can operate it." And so that's when I fell into the COO role and was able to bring him from 92 million annual sales all the way up to 147 million. So from that, that's what really sparked the interest, or even more interest in the business industry. However, I felt like I hit a ceiling at that time. I felt like there was no more room for me to grow. The residential industry is all based off of feelings, and it's based off of market corrections. Look what's happening right now. I just got off the phone or this morning, my girlfriend called me, and she's in the residential industry on the construction side. And she said, "We just placed 12 offers on homes." She works with an investor, 12 offers on single family homes here in Charlotte, all way below market. And she said that they're all coming back trying to negotiate with us. And she said, compared to Q1, we wouldn't even have a shot on where we're offering on these homes.
Yeah.
And so she's seeing a change, and you see a change when they increase interest rates slightly. That for that type of individual who can afford a $500,000 house, now they can only afford a $350,000 house. Well, in this market in Charlotte, you're not going to get much for $350,000. So you're going to end up going to rent. And so I realized that very quickly that it's a huge feelings-based type of transaction. It is fluctuated by any type of market correction. And I said I wanted to be on the ownership side. I want to play the game Monopoly, but in real life. And when you play the game Monopoly, you and I played the game.
Yep.
You can't play it in an hour.
Right.
It's a game you play over 4 to 5 hours, and you may even get so bored that you say, "Hey, why don't we leave everything and go get a bite to eat or resume this tomorrow?" Because it takes so long. That is how you have to build a portfolio in commercial real estate. It takes time. You're not going to do it overnight like playing the game Monopoly. However, with the game Monopoly, what do you first start out with? You start out with a single family home. Then you start out with a fourplex or sixplex, and then they say a hotel. They call it hotels. I call them apartments because I love apartments. I put apartments on my land. And so that's where you start out with. All you have to do is play the game of Monopoly, but in real life. And before you jump into the game of Monopoly, you think you may know it, read the rule book, because the rule books talk about cost segregation and bonus depreciation in real life. And a lot of people don't know the bonus depreciation is going down after this year. Right. It starts going down to 80, 60, 40, 20, and then goodbye unless a certain party gets in to reinstate it. However, you need to read the rule book before you play the real game of Monopoly in real life. But I realized that, and I said, I want to play the game Monopoly in real life.
Mm-hmm.
And that's what I'm doing. I'm buying up real estate.
Yeah, cash flowing assets. Like that's what it's all about.
Cash flowing assets, and better yet, we're not just buying it by ourselves as a company. We're helping other people. We're giving the ability to other people, regular individuals, to also participate in these larger deals, and they don't have to go to Wall Street to those REITs. They don't have to go to Wall Street and place their capital, which that's what everyone in society is geared towards: is retire, put your money in Wall Street. No, you should have options, and we're able to give the ability to those individuals to have those options to invest into larger real estate.
Yeah, that's tremendous. Well, it's so funny. We were talking offline about the law of attraction, and I was saying how I've had a couple guests on from the Carolinas, and I've had guests on that are younger, and here you are, and then you go into this whole really well made point about the single family space, which we've talked about in the last couple episodes I've had, and so it's funny how the same themes keep coming up, but it's worth really highlighting this, which is the valuation process of single family homes versus commercial real estate. And like you said, Chris, the single family space is based largely on, it's based fully on comps, which are established by single appraisers that, go out and give their opinion on value. And the comps that he's using are comps down the street, comps in the neighborhood. And one of these comps could have been distressed.
They could have been getting a divorce, and the husband is mad at the wife, or vice versa. And they say, if I live in a $500,000 neighborhood, let's just sell it for $250. Forget it.
Right.
I want to. They want to bicker back and forth and hurt each other. So they're one say, let's just sell it for $250. Now, half your value. They're going to look at that as a comp, and it could hurt your property potentially.
Yeah, and it's just there's so many wild cards in that, and the emotional factor, like. People walking into a house and, this is a great house, but I really hate that accent wall, And so like,
and that's what would get me when I was a broker is I would sell $1 million house, and she's like, I don't like the color. I'm like, pay $3,000 and paint it gray.
Yeah, right.
I mean, you're buying $1 million house. Can you pay $3,000 to paint it gray? You're not going to buy a house based off color on the insides? Like, okay.
Yeah. Buyers can be funny and finicky and whatnot, but and then you compare that with the valuation of commercial real estate. It's based 100% on income and revenue generated. So your net operating income, and of course the market cap rate. But that makes the valuation process much more scientific and predictable, underwritable, and which mitigates so much risk because you can much more accurately capture your exit strategy or exit plan in your underwriting. And so you're dealing with a heavily risk mitigated space compared to single family houses. Then you throw in all the advantages of scale, whether you're doing a 10 unit or 100 unit or 1 unit, they're largely the same amount of work and the same activities. And you're doing one loan, you're doing an appraisal, you're doing due diligence. You're closing the deal, raising capital potentially. So, again, just kind of back to the magic of the multifamily space and all the attributes you mentioned, cost segregation, bonus depreciation, like the tax advantages from that. It's just obviously Chris and I are huge believers in this space to the point that we're willing to bring other people's money into the deals.
Yep.
And whether that's family, friends, or investors in our network, we feel so good about that because, like you said, Chris, it's an opportunity that you're creating and offering to people to be involved in ownership of these big cash flowing assets. It's
100%. And with our offerings that we offer, we just released QC Capital Fund 2 to buy Class A assets throughout the Southeast. Me personally, I always place my own personal capital alongside of our investors. All of our investors know that my capital personally is placed next to theirs. So we've aligned our interest.
Yeah.
And the team knows that we will only pursue a deal that we're willing to invest in. I mean, we are not going to bring a deal to our partners. And when I say partners, I mean our investors. We're not going to bring a deal to our partners if we're not going to invest in the deal. I don't see why, some people will do that. I mean, that it blows my mind that they're going to just bring a deal to someone and ask them to, partner with them and invest alongside of them. And they're not even going to invest their own hard-earned capital themselves. So we always invest alongside of our investing partners because we're a firm believer in real estate. We're a firm believer in cash flow, and we love to invest in real estate.
Yeah. So properties that you're buying now, are they cash flowing properties in place, or how do you criteria that?
Yeah, so our properties are cash flowing heavily. They're Class A in prominent, great locations. That's the biggest thing I learned even 7.5 years ago when I was a broker in residential real estate, is that it's location, location, location. And that's what we're finding. So we like to find great properties in great locations, very similar or very close to proximity of a Chick-fil-A, a Starbucks, a Target. Those type of companies has done extensive demographic research on who's willing to buy an $8 cup of coffee, who's willing to eat Chick-fil-A. And so that's something that we like to look for, is where's our property in proximity to those locations. And those properties produce great cash flow. We offer 3 different type of investment classes, which you can, if you visit our website, you'll be able to see those type of investment classes that we offer for returns to our investing partners. And we really focus on cash flow. We look at IRR. IRR can be misconstrued so many times because it takes in consideration time. So if I decide to throw a refinance in there, IRR can shoot up. If I decide not to throw a refinance in there, IRR can stay low. If I decide to sell in a year and a half compared to 7 years, IRR is going to fluctuate. So we do look at IRR to a certain extent, and that's anywhere from a 11+% IRR range, because we know IRR can be misconstrued. We really like to see how much is the property producing in cash flow and what's our potential equity multiple. I'm a firm believer of looking at the equity multiple. That can give me a good range on what am I going to get back on my investment. But we are a firm believer of cash flow because we know IRR can be misconstrued pretty heavily when it comes to setting your exit cap or timing of you getting out of an investment, things like that.
So is cash on cash your main metric then that you're looking at, or average annual return? Or
we heavily lean towards cash on cash. We like to see what's the average cash on cash. We do look at all 4, which is equity multiple, cash on cash, annual return, and IRR. But we heavily lean towards cash on cash.
And what are you shooting for with cash on cash on your deals? Like ideally?
Yeah, we like to see anywhere from an average 5 to 8+%. I mean, I've looked at some offerings that come in my inbox, and I don't know how they do it. I mean, maybe I should take a crash course lesson on how they're doing it, but they're receiving a 12% or average cash on cash annually. And I'm like, well, 12%. I mean, I've been in the space, quite a bit, but and we're focused on newer assets, but I've never even seen with the older assets 12+% cash on cash. So it's very interesting when I see those type of offerings come into my inbox. It makes me scratch my head on it.
Yeah. So have you always gone after Class A stuff?
No, we haven't. Prior to COVID, we were 1980s, 90s type of assets. And because Class A had lower returns, and COVID really made us switch our whole criteria to focusing on only newer assets. You have stronger collections, stronger tenant demographics that actually care about their credit. And you are able to have an asset that is a lot less riskier, in my opinion, because it's you have a lot less deferred maintenance and your collections are 100% compared to an older asset. You have very light renovations on the newer assets. Also, they are poised for a stronger type of buyer when you do decide to sell. So we like to look at all that, and your newer assets are going to be in great locations. Your older assets are normally going to be in your suburbs or your MSAs of cities. So we like to look at all that. And what we found right after COVID is that the returns were very similar. to the older assets. The
Yeah.
older assets were 12 to 15%, and the newer assets were 12 to 15%. So we scratched our heads and said, why are we looking at older assets if if it's more risk? The collections, fluctuate substantially, very similar to like Bitcoin, and you have a larger risk when it comes to your tenants in there. And so that's when we pivoted to the newer asset class, and we love it.
Yeah. And those of you that know the show and know Greenlight and follow what we're doing, know that, our first 6-7 acquisitions were all Class C value add projects.
Yeah.
And look, you run into some tough stuff in that classification, and particularly with your tenant base and the quality of people that care about, like you said, people that either care or don't care about their credit, the condition of the property they're living in, whether or not they, whether or not they're going to get a good referral on their, all that stuff. Like with Class C value add, a distressed Class C property, you can kind of throw all that stuff out the window and just assume that you got a tenant base. And I hate to be stereotypical, but you got a tenant base that just doesn't care nearly as much about their living conditions, about their financial health, and that creates a lot of like economic and management challenges in addition to all the CapEx that you're doing, and you're subject to labor costs and material costs. And in my opinion, you're throwing, when you do a heavy lift Class C or even a medium lift Class C, you're throwing so many moving parts into the equation, and you're at so many other people's mercy as far as performance, that you said it well, Chris. You mitigate a lot of risk by moving up an asset class to particularly a tenant base that is much more manageable, much more kind of predictable, less volatile, less and more responsible, and there's so many advantages that go along with that. And
to touch on that, we have a property in San Antonio we love dearly. And by the third of every month, it's 100% collected. Our asset management call literally is like less than 15 minutes. Our asset management call is less than 15 minutes.
Interesting. Is that weekly? Do you guys do a weekly call?
We do weekly, yes.
Yeah.
And we talk, about how the property's performing and things like that. And with these newer type of properties, your asset management call is anywhere from 15 to 30 minutes at max that I found. With the older type of assets, you bake in an hour to maybe an hour and a half for those asset management calls to talk about strategy, what's happening to the property, evictions, what you can do to gain, get people to collect rent or to pay their rent, and now there's a lot of companies out there that are offering benefits, but these newer type of assets are definitely a lot easier when it comes to asset management. Yeah.
And then you throw in another element, which is, the level of property management company that you're going to get for a value add Class C distressed versus a stabilized Class A, or even an unstabilized Class A. It's kind of the same thing as the tenant base. Like the property managers in those two spaces are quite different from each other in terms of, just level of professionalism, level of resourcing, quality of reporting, and kind of what we found is overall level of care and concern about the property and the business plan. And guess what? Like, that's where the rubber meets the road, is where it is on your business plan implementation. And when you're using third-party property management, which I recommend to everybody until you're quite scaled up, you're at the mercy of that property management's performance. And you can asset manage the heck out of them, and you should, but at the end of the day, they're the ones that are implementing the plan that you've created to stabilize that property. And look, if they're either not committed or understaffed or undercapitalized or, just spread too thin, anything like that, like, it's going to hurt badly. And, I'm speaking from experience here. We had to fire a property manager 6 months into a number of properties that they were managing for us. And it put us way behind, like, as far as stabilizing the properties and establishing cash flow and everything else. And it was painful, man. It was like, one of the hardest things to kind of navigate through. And, so long story short, Greenlight is now going after Class A. We bought a Class A in Columbus, brand new build, or a couple months ago. We closed on that, and we're under contract on another one, and another one in the pipe. So for us, it's the same thing. Like, we kind of saw the light on particularly the quality of the tenant base and property management that you get in those Class A. And like you said, I mean, the returns are going to be very, very similar. And you can even find, either a light value add as far as like cosmetic updates, or even a more of a value add in that space. Obviously a value add component changes your economics quite a bit. So, a lot of times it's a management play where you're just taking over for management that hasn't kept up with market rents and just general kind of, industry standard type management of the property. And those are great plays too, because you bring in a great property manager to clean that up. And all of a sudden the property is performing better, rents are higher, your NOI is higher, and you're off and running. So, dude, that's awesome. So, let's talk about, I mean, I'm sure you guys have some deals in the pipe right now. Or I'm assuming that, talk a little bit about those, kind of, what they're like as far as scale, and, your unit count, price, and all, in your business plan for those.
Yeah, very, very much so. So current, we have two offerings. One is our QC Capital Fund 2 that we have just released. We actually have a webinar this evening on that. I know this probably won't air today, but we have a webinar on that, and you can learn more information on our website, qccapitalgroup.com, for our QC Capital Fund 2.
Yep.
The first deal that we have not announced, but by the time this goes live, everyone will know of it. We have a deal in Houston, which is located in the Med Center. It's a 224 unit Class B plus asset built in 2003. Great value add component to it, nice. Where we can go in and do a light touch up with painting the cabinets, backsplash painting, granite countertops, very light LED light fixtures, nothing heavy. And we're going to be able to increase rents there. It's an older owner that has owned the property. The benefit of this particular asset, it is a loan assumption of HUD. So we are actually getting a 2.75% interest rate.
Wow.
Yes. And I believe that's good for the next 30 years. So it's a great property where we can hold very, very long term in a well-located asset. So we're extremely excited to have that one launch, our QC Capital Fund 2, which we'll be sending out more information on that particular asset soon.
How did you source that deal?
We have a director of acquisitions that builds great relationships with brokers and owners throughout the Southeast. And he's done a phenomenal job of keeping our deal list pretty heavy, let me say, because it keeps our team fairly busy. So he's done a great job at that.
Yeah. So it was a broker deal. Do you know if it was off market or if it was on market or kind of a hybrid? Like you see a lot of.
It was a hybrid. It was baked into a portfolio, and it was a hybrid, and we were able to take it from the other three assets.
Yeah. Okay. Great. So, and I love the strategy of kind of a cosmetic upgrade on these, Class B, B plus A assets, because, painting and backsplash and maybe changing countertops and painting cabinets and stuff, like, I mean, it's not heavy lift at all, and it's very doable. It's very budgetable, and a lot of times you can get $200, $300, $400 more a unit by doing that stuff and just bringing it up to your high market comps that you're going against in the space. So man, that's an awesome deal. What's the acquisition price on that?
That one's going to be around $47 million. The way the debt currently sits, will probably be around a $26 million raise.
Okay, so 26. I was going to ask you about that. So $26 million raise. How do you guys crack that nut? Are you bringing in institutional equity and then raising the rest, or how does that go?
Yeah, so that's all going to be our investing partners. So there's going to be at this time no institutional equity that will be coming in. There may be a couple fund of funds, or there will be a couple fund of funds as we partner with fund of funds. That's how our model is structured, co-GPs, and we'll have some institutions that have expressed interest in coming in, smaller institutions like hedge funds. And those are private individuals that we have relationships with, but it's mainly going to be your accredited investors, as we only operate as a 506c for all of our type of offerings.
Yeah. Yeah. So you guys have a pretty robust capital raising program. If you're taking on a $27 million raise, and most of it's going to be your own retail investor, it sounds like.
That is correct. Yes.
Yeah. How have you guys developed that? Let's dive in specifically to your your CRM, your marketing to that group, and your recruiting of that group. Like, with the meat of that group, where how have you gotten them on board, and how have you kind of nurtured them to the point of investing with you?
Yeah, it's very important. I've told my managing partner and team that my goal with QC is to become a capital raising machine where we raise substantial amount of capital. There's multiple different avenues to do so when it comes to it. And any business these days, you have to market. You have to learn how to market. You have to know how to market. And so I've taken classes and courses to learn how to market properly. And I think that has been a huge benefit to us, is that all of our offerings that we send out are professional. They look good. If you go to any of our pitch decks, every time I send out an offering, I get 4 or 5 emails and text messages on who did your pitch deck. Can we get that contact? Which is, it's an in-house person, so they can't. We make sure our offerings are professional, high quality type of offerings when we present them to our investing partners. And then it comes a huge amount comes to referrals. We do social media advertisement as well. We're starting LinkedIn advertisement, and we do have a couple other advertisement sources that we will be utilizing and have already utilized to grow our investing base.
How did you mentioned referrals. How have you built that list, like your CRM list?
We built it over time. Built it through our social media, where I have a social media guy who's active on Instagram, so he posts a lot of content for me on Instagram. I am no longer on Instagram, and it feels good. But he posts on Instagram, so we're fairly active on social media, which helps really spread the word of the company. And from there, that we are more of an offensive type of player, even with our advertisement throughout social media and our other advertising sources. We're more of an offensive type, where we are out there calling, following up with them. We built a full list of a drip campaign, basically, where it's going to follow up with you multiple times. And we've had some great calls with some fairly large investors that have reached out and said, we love your follow-up. We love your consistency of follow-up in the education that you're sending us. And we've contacted firms that have 3 to 4 billion assets under management, and they don't even give us the time of day like you guys have, or the information that you guys have. So one thing I've done with our director of investor relations who came on board is I gave him a task to go ahead and reach out to all of our competitors. Understand what they're doing, how they're doing it, how they're marketing, what type of content they're posting out, how many times they follow up, what's the consistency of that follow-up, what's their newsletters look like. And after we gathered all that information, we said, okay, this is how we're going to build ours. And we built ours that way. Yeah,
that's tremendous. And you mentioned it sounds like you've completed your first fund.
Correct.
Yeah. How big was that fund?
That was a small fund. We wanted to test our investor base. It was a little over $1 million. We wanted to get an idea of when we send out an opportunity as a fund, how many investors would be attracted to it. And we saw a good amount. We still have those in certain investors that are like, no, we want the actual deal itself compared to the fund.
Right.
So we've really wanted to test it to see their appetite.
Yeah, a little proof of concept. That's great. It seems like it'd be harder to make a fund opportunity kind of sexy because when you're than an actual live property, when you've got the property, you've got the story, the features, the benefits, the amenities. There's so much to show and say about a property that and probably lean on that almost a little too much sometimes where like with a fund you're selling the company, right? Like the company's vision, the strategies, the way they mitigate risk, and obviously you're selling the opportunity to invest in that company, but that's largely you're selling a vision. And of course you're saying like we're going to go after this asset class, this type of asset with these qualifications, but you don't have that dangling lure, so to speak, to of the property to make that pitch. Have you guys found any secrets to marketing funds that have been helpful?
When it comes to marketing, and especially marketing the funds, we're utilizing social media platforms, and
Okay.
we've been able to utilize those to our benefits to market the fund and market specific deals that we are targeting for the fund, and that's helped tremendously, really gather and gain those leads and those conversations with potential investors.
Yeah, got it. Okay, cool. So tell me a little bit about your team. It sounds like you've got a pretty good size team around you, pretty robust team. Director of acquisitions, you mentioned, director of investor relations, you mentioned. Start with like when you were scaling and growing, who did you hire first and how did that progression go?
Yeah, so it was now our managing partner who came on. He came on as an underwriter to
Mm.
underwrite all the deals, and then from there it went from a acquisition associate. Once the acquisition associate came on, he moved into the director's role after basically after proving himself. From there, it was our director of investor relations now, who oversees all the investor relations and leads that come in. Now, in between there, we do have marketing individuals. I consider them as QC Capital employees because the QC Capital basically pays them an employee's salary.
Right.
And so they are categorized as a QC Capital employee, which we have three that are in our marketing. Technically four, actually, and they're all in marketing. So we have
Okay.
social media marketing, Google marketing. We have someone who edits all of our content to go out, and then we have a content videographer.
Oh wow. Cool. Any thoughts of or any plans to go vertical with property management? I know you're in a bunch of different markets. That sounds like it'd be kind of tough to do that.
There are plans to go vertical. It's going to be at the right moment. So
Yeah.
we'll go vertical at the right moment when we have enough AUM on unit count
Hmm.
in our portfolio. We'll go ahead and go vertical.
Yeah. Yeah. Awesome. So to switch gears completely and kind of start to bring some of this full circle, and you and I are both mindset junkies. We're
Oh yeah,
really into your what's the name of your podcast? The
mindful
multi
multifamily show.
Yeah, mindful multifamily show. I love that name. People that have been listening to me for a long time know I think mindset's foundational in all aspects of this business. Like, it's a huge, crucial part of everything you do. And the reality is, especially when you're starting out, like your limiting beliefs determine how high you can go. And so, busting through those limiting beliefs and becoming a master of your mindset is what it takes to really scale up, become successful, build a company like Chris has built, be that, I mean, geez, 246 units, I think, in Houston, Class A, like that's the next project. They're just cooking, right? They're moving along, and 1,000 doors so far. And so, we, both of us are big believers in the law of attraction. We were talking offline before the episode started. And, for those of you that aren't familiar with law of attraction, it's a concept that basically states that your thinking, your mindset, if you will, determines your reality. And if you think it and believe it, you can achieve it. I think that's Napoleon Hill.
Yes.
So law of attraction's been around a long time. The movie The Secret in the 90s or I guess 2000s when it came out, really encapsulated the law of attraction. And on a business level, to me, it's like paramount. Like, who you are and what you put out determines what you get back. So, and Chris, tell us a story that you told me offline about this. It's remarkable. And it really, to me, it shows kind of how powerful you are as an attractor and as a person.
Thank you.
Yeah, tell us that story.
Yeah, I'm a firm believer of laws of attraction. I meditate in the mornings and in the evenings,
Nice.
and I'm a firm believer of it. I would say, I've been in the real estate industry almost 8 years. I've spent around 10 years of really studying laws of attraction. And when I first started learning about it, obviously it wasn't, in my opinion, wasn't strong at all. And it started to progress year over year. It's funny, one story before I get to that one is that when I was on Instagram in 2018, I posted a white Range Rover with black rims. And I said, one day this will be in my driveway. Well, a year ago, if you look at my driveway, I have that exact same, a newer version, but that exact same white Range Rover with black rims in my driveway.
Yeah,
and I posted that in 2018. So the laws of attraction, and what we were discussing is that I was in New York City last weekend with my girlfriend, and I was telling her that I normally love to stay at the Wagner Hotel, which is right there in the Battery or Financial District, and your hotel room oversees the Statue of Liberty. It's a beautiful hotel, love it. It's a very nice, and I said, unfortunately, it closed, so we stayed somewhere else. And I said, unfortunately, it closed, and it was just very, very nice hotel. It closed due to COVID. They said. And she said, well, if you would buy it, what do you think it'd be worth? And I said, probably be worth 200 to 300 million. It's a nice location. It's fairly big. The rooms are bigger. So probably 200 to 300 million. And ironically, late last night, I get a broker that emails me and says, hey, I have 3 hotels in Manhattan. Would you like to take a look at them? Well, we're multifamily guys. So, it's very unusual that we would get a hospitality broker to email to ask if we're interested. Yeah. So I said, that's funny. I just left New York over the weekend. Yeah, I'd be interested. Shoot me an email of it. Well, one of the hotels was the Wagner. It's on the market. It's listed for 210 million. And I said, wow. We were just discussing it this weekend, and now I get an email, and it's the hotel that we were just discussing that I love that is for sale. How does that happen?
It's in the price range that you even said it would be in. I mean, dude, that's awesome. I mean, that to me, it's one of those stories that, can kind of put like chills on your neck or on your back. It's like, it's almost eerie, but it's not. If you studied the law of attraction for a while and have been practicing things like meditation and visualization and vision boards and that sort of thing, you start to see these serendipities and these synchronicities show up, and they're so cool. It's magical the way that it can happen. And, if nothing else, like that email that you got 3 days later after having that conversation, or 4 days later, it probably just, if nothing else, you may or may not like even look at buying the property, but it's got to be like affirming to you that like, you're in a very creative space right now, and kind of in the zone, if you will, when you can speak something, essentially speak it into existence. Like, what comes out of your mouth, the power of your languaging, the power of your word creates external realities for you. Sometimes that seem like almost like magical and, just kind of crazy. Like, I mean, how does that feel to you? Do you feel that level of like affirmation and whatnot?
I love it. It's kind of like a drug, honestly. And when I meditate in the mornings and the evenings, I do those same type of affirmations and things like that during depending on the type of meditation that I'm doing. And at first I was shocked. At first, when it kept happening, I was like, yeah, this is not real. And then it kept going on, and I was like, wow, like your mind is extremely powerful. And that's what really drew me, and I fell in love with understanding the mind, how we think, how we operate, why we make the decisions we make, and to better understand it. One thing that I did while I was in New York, and I love business tremendously. We were at this famous diner, and she looks over at me. She goes, "How much do you think this diner racks in or brings in income?" And I look around, and I said, "Well, they're open from 9 to 2 in the morning." I said, "They're always packed like this. They're a couple blocks from Times Square." I said, "I bet you they bring in anywhere from 100 to 145,000 a night." And I said, I looked at the building. I said, their rent is probably anywhere from 350 to 500,000 a month. And I said, based off those type of calculations, they probably bring in anywhere from 40 to 50 million gross a year.
Wow.
She goes, no way. So I called over the manager. I said, do you mind swiping your card? I'd like to know what your gross is this, and how many people you have in here. And I told her too, she asked how many people they saw. And I said, they probably see anywhere from 2,500 to 4,000 people a day. Wow. And she goes, there's no way. And so he swiped his card. He said, we're at almost 3,000 people today. And I said, and this was at like 11 o'clock. And I said, look, 3,000 people, they'll probably hit by 3,500 by tonight. And he looked over at me. He said, yeah, you're right. We'll probably average around 3,500 tonight, or hit 3,500 people tonight. I said, what's your gross right now? He said, we're at 109. I said, 109 for the day. I said, your average on a daily basis, probably 100 to 135. He goes, yes. I said, what's your rent? He said, 400,000 even. And I looked at her and I said, spot on, spot on.
Yeah.
And so that mindset that I was able to cultivate also has helped me in business by just analyzing, sitting in a restaurant, analyzing the restaurant, analyzing the square footage, and getting a pretty good estimate of what their gross income, and then obviously it's very easy. Restaurants are 18 to 23% net. So getting a good idea of what the owner makes.
Yeah.
And that has helped me cultivate the laws of attraction as well.
Yeah. I mean, just being smart, knowing, and being curious, right? Like learning, absorbing, and kind of becoming an expert in the subjects that are important to you. In your case, it's business, and so you've got those analytics down. But man, you nailed it. That's awesome. Yeah. Well, we're starting to bump up against time. I hate that, because this has just been an awesome conversation. But I want to make sure that we have time for you to really answer this question. You're really like like I said, you're really in the zone. You're into an amazing trajectory. You're far along in it, and you're young. You've got a long runway to go. And well, a couple things. So number one, but this is the biggest question I want to ask, is like, it wasn't that long ago that you hadn't done any of this yet. And I guess if you could kind of go back to that person that doesn't have all this business experience and knowledge and just kind of production, right? How would you coach that person? And the reason I'm asking that is because it's kind of the same situation that a lot of the listeners are in. And so what you would say to yourself in that situation is probably what you'd say to a lot of listeners in their situation. So, how would you coach that person that is, kind of just getting started?
Yeah. And one thing to clarify, just getting started into our type of industry, right?
Yeah, exactly.
Yeah. If you are, now this is geared towards individuals who want to create a private equity company, very similar to QC Capital or Greenlight Equity Group. I would say build a equity/capital raising company. Build a capital raising / equity machine. Where you can raise 20 to 50 million on a per deal basis by one email in less than 24 hours. Focus on marketing, focus on building your investor base. There will always be deals out there. During recessions, during market correction, there will always be deals out there. Why? People mismanage deals. People don't care. There will always be deals out there. focus on growing a company that raises substantial amount of equity. Equity is always needed, always will be needed to close these deals. So if you can focus on a company that will raise substantial amount of equity, you're going to have a long-lasting business, in my opinion. The team knows that my goal is to build a company that we can raise 24 million in less than 3 days, just by sending out an email. So build a strong capital raising machine.
Yeah. Yeah. Well said. That's that's really like, that's hitting home for me. Like, I mentored with a guy that really taught us how to, I mean, he was a capital raiser for sure, but, and maybe it was my focus, but it was all about getting the deals, right? Yep. And finding the deals, getting broker relationships going, getting that pipeline going. And guess what? I mean, 2 deals in, 3 deals in, you're bumping up against your capital raising constraints. And you can start to look towards like institutional equity, pref equity, JV equity, that sort of family offices, that sort of stuff. But first of all, it's way more expensive. Oh, yeah. You have way less control over them and the deal. And because they want control over the deal to some extent or large extent. And they're not your investors. So you haven't conditioned them and coached them and all that stuff. And so if you're able to raise like, the amounts that you're talking about, $20-30 million from your own retail investors that you've nurtured, man, that's powerful. And that's going to allow you to get so much more done in the grand scheme of things. So
very much so.
That's great advice. So, Chris, any like kind of final thoughts? I guess I'd just say, thank you, dude. This has been amazing. But do you have any kind of anything to wrap up with?
Yeah, would love to connect with anyone. If you go to our website, qccapitalgroup.com, top right-hand corner, it's called Become an Investing Partner. We call all of our investors partners because we are partners in these deals. And fill out the information. One of our team members will be with you. And all the information we talked about plus more, I decided with our managing partner to write a book called the Multifamily Real Estate Investing Booklet. You can find it on Amazon. We don't make any money off of it. It's just basically the break-even price of it. And that has everything that I've learned over the past 3.5-4 years in the multifamily industry to help you understand about real estate, to help you understand about investing, taking that first leap into investing in these larger deals.
That's awesome. That's awesome. So guys, check out that book. Find Chris Salerno, at his website. Are you? I'm sure you're on the social media. You said you're not on Instagram anymore.
Nope. I am on Instagram. I just have a guy that manages it. So Instagram is just Chris_Salerno. And then if you find me on LinkedIn or Facebook, it's just Chris Salerno. You'll be able to find myself. But feel free to follow us on all social media platforms. We do post daily and weekly educational content on what's going on in the market, what we're doing, how we're staying ahead of the curve, and what we're buying.
Yeah. So guys, quite frankly, Chris is a stud in this space. He's killing it. And so listeners, these are the people that you want to surround yourself with. And by that, I mean, follow on social media, read their materials. You want to put yourself in the right rooms, right? We talk about that a lot, and that can be a digital room. It can be a book. But you want to really be surrounding yourself with people like Chris, that are just, they're just crushing it. And so, dude, I'm super grateful for you coming on the show and kind of opening your playbook, sharing with us what you're up to, your excitement, your motivation, your drive, and also your strategies and kind of what you're doing. That's really smart. This has just been amazingly valuable to me. And I know a lot of the listeners are getting a ton out of this. So thanks a ton.
Yeah, thanks so much for having me. Very excited. Looking forward to being on in the near future.
Yeah, I'd love to have you back. Absolutely. So listeners, thank you so much. This is hopefully you're getting a ton out of these. We've been on a string of really powerful episodes here recently. We're doing 2 a week right now. And so we'll see you in about 2, 3, 4 days on the next episode. So take care, everybody. Go get them.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, Go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of The Apartment Gurus.